again and welcome back to another session of Commerce class with me, Suman Rathore. Friends, insurance plays an important role in the development of business activities. A businessman is exposed to various kinds of risk, like risk of life or risk of damage to property or goods or theft of goods, etc. All these risks cannot be eliminated completely, but efforts can be made to minimize these risks. And one such method of minimizing or sharing of risk is known as insurance. Actually, insurance is a contract wherein the insurer agrees to indemnify the insured in return for a consideration called premium against the loss or damage suffered by him due to the happening of a specified event. And there are some important terms related to insurance like first is policy. Now policy is an agreement or contract in writing which contains the terms and condition of insurance contract. Second is premium. Now premium is the small periodic payment made by the insured in return of which the insurer pays the compensation on happening of an event. Third is insurer. Now, insurer is the first party in a contract of insurance who agrees to pay the compensation. Next is insured. Now, insured is the second party in a contract of insurance whose risk is covered or minimized by the insurance company. Next is assurance. Now, assurance is a contract under which the sum assured is bound to be paid sooner or later, which means that the policy amount will be paid either on the happening of a certain event or on expiry of a stipulated time period. Next is double insurance. Now, double insurance is a type of insurance wherein the same subject matter is insured with two or more independent insurers. And next is surrender value. Now, surrender value is the amount which the insured gets if he is unable or unwilling to pay the premium. Now, insurance plays a very important role in modern business. It performs various functions like first is protection. Now, the most important function of insurance is to provide protection against the uncertainties in business. Insurance does not eliminate risk, but it assures to compensate in case of losses arising out of uncertainties. As a result, businessmen have a sense of security and freedom from anxiety. Insurance enables them to carry on business with confidence and peace of mind. Next is sharing of risk. Now, insurance creates a pool of premiums from where the compensations are paid to the suffered insured parties. If an individual has to bear the loss himself, he may be completely ruined. By transferring his risk to an insurance company, businessmen can run their activities smoothly. For example, let us assume in a city, 1,000 house owners decide to insure their houses against fire. Every house owner will make some payment for the insurance cover, which is called premium. Some houses are likely to get burnt in case of a fire, but the probability that all will burn is very remote. Now suppose the total insurance fund created by contributions is rupees 50 lakhs, and then 10 houses suffer a total loss of rupees 40 lakh by fire during the period of insurance. Now, the owners of these houses will be indemnified or compensated out of the fund created by way of premium contributions by all. Now, rest of the money will be utilized to meet the expenses and profits of insurance company. Next is reduces uncertainties. Insurance cannot remove the uncertainty element from the business, but it helps a business in overcoming the losses arising because of such uncertainties, as insurance is a contract to make good the loss suffered due to the happening of some uncertain events in future. Next is ability to face competition. In these days of cutthroat competition, a businessman cannot operate successfully if he has to bear all the risk himself. Insurance helps in improving the efficiency of business by contributing to the survival and continuity of business. Business concerns can ensure the lives of partners and key executives to avoid disruption of business operations and provides a long-term visibility to business. Next is capital formation. Insurance companies mobilize public savings and invest them in industry. The amount collected by way of premiums from policyholders are invested in income generating schemes by insurance companies. Thus, it provides necessary capital to industrial and government enterprises. Next is investment. Again, insurance inculcates the habit of saving among people and mobilize these savings to productive uses. It combines the element of investment with protection for policyholders, like in case of life insurance policy. It not only provides protection but is a sort of investment also, as the assured sum is returnable either at the time of death or at the expiry of certain period, or in case of insurance policy with pension plans for old age security. Next is better utilization of capital. In the absence of insurance facilities, businessmen will have to maintain a large reserve to face risk due to loss. Insurance avoids the need for such reserves, and the funds so released can be invested to generate additional wealth. Next is facility for loan. A trader can get bank loan easily if his stock or property is insured, as insurance provides a sense of security to the lender. Loans can be obtained on the security of life insurance policies also. Insurance companies provides loans and underwriting facilities to businessmen and also invest in the industrial securities. Next is division of labor. Insurance facilitates division of labor or specialization. A businessman can concentrate fully on his own business because his risks are taken over by an insurance company which is a specialist in bearing risk. As such, insurance is a social device for pooling and dividing risk among a large number of persons. That's all for today. Thanks for staying in tune and don't forget to like and subscribe my channel. Thank you and goodbye for now.